I don't normally wear a coat. This is a coat today. I'm wearing a coat. Why am I wearing a coat? Well, it's been a pretty rough week. It's been a rough week for me, and it's definitely been a rough week for you if you've been following the most recent suggestions and ideas of this channel, which have been particularly to have exposure to the energy sector. The energy sector has been the highest performing sector of the entire market all year, and still is after this most recent sell-off. And I've been talking and kind of saying the same things the past several days. Today I want to say something new, and this is the last new piece that I believe that needs to be said before we head into the crucial 2 weeks of earnings and energy earnings. So if you look at how energy has been the top performing sector of the market, you can see it's had two very obvious bursts so far, followed by two very obvious drawdowns of relatively similar length. The first burst came right after Q4 2020. A couple weeks after Q4 2020, mid-January, you had this very sharp rally across the entire energy sector, and then you had a very sharp pullback. Right as the high speculative tech stocks pulled back, the market more broadly pulled back. That was whoa, maybe we're overestimating the market, overestimating vaccines. Energy pulled back after that very strong rally, had a very strong pullback, but made a higher low than it was when it began that after Q4 rally, the start of earnings season rally, the receiving Q4 earnings in the beginning of Q1 and beyond, more kind of middle of the first month period rally. If you look at that, you will see that chart. You got that initial bump down that came back down to a higher low than the previous low. And then after you hit that higher low, you had another and even greater second rally. If you look at the second of the two energy rallies, you'll see a very similar timing. Right around mid-April, you get an energy rally. This is when we're getting earnings, and the energy sector has two sections of rally. The second of the two, this time though, is less enthusiastic. And there might be a reason for that. We'll compare that to the OIH, but we'll get to that in a second. In both of these energy rallies, you see a period where the S&P is flat and volatile. Today, it wasn't just energy that was down. It was the S&P and the NASDAQ and the Dow. The entire market was down. Again, we are entering another earnings season. That began this week. 22% of companies report next week. We've got a large number the week after that. No energy companies this week. We've got some next week, a lot the week after that. What's happened that I've noticed going into these earnings seasons is the market has continued to be on a strong rally. And it obviously has been the past several weeks leading up to this week when the NASDAQ had its first down week in 4 weeks. The market anticipates high earnings for most sectors. And we get these earnings, they are better than expectations, then the stocks, don't do anything crazy. They kind of chill, they pull back, unless they do something absolutely wild. Then they have a light rally. We're seeing this in the banking sector in particular. All the banks, except for I believe Wells Fargo, sold off despite having fantastic quarters and beating expectations right after posting earnings. And yes, interest rates have been down, so that is a fundamental thing that affects the banks. But they are still down on earnings, better than expected earnings, and we all know interest rates are going to go up in the long run, so is what it is. Anyways, people have been very bearish energy companies, but they beat expectations, and the stocks begin a bull run. So, similar to what we've seen in the last two periods of earnings, let's see what he's talking about right now, not for us. similar to what's been happening in the last two periods of earnings, I believe energy companies are about to report their best earnings they've definitely seen since pre-pandemic, and that they've seen in several years. The price per barrel is very high. Their cost structure is significantly better. They aren't spending all this money in exploration. And I think they're going, and price per barrel is the highest it's been in 5 or 6 years. So I think the forward-looking outlook, as the rest of the world catches up to the United States, and the United States has more catching up to do, I think the outlook is going to remain very positive. So I think we are in for another energy rally, despite having a sell-off that is very similar to the one between runs 1 and 2 that we had seen this year. A similar sell-off, we've had that, and I believe the next stage is another energy run, and the last crucial point is a higher low. We have made a higher low from the previous drawdown. Consolidation, some might call it. We're going to call it a drawdown because that's what it is. It's a bearish move, and we think it's been overplayed. It has been played through. So for those reasons, we are remaining in energy. I'm not seeing weakening in the economy, not in the domestic economy, which is the largest economy. Yes, there are concerns around the Delta variant, but even if we get another wave, there's several things we have to remember, one of which is for this wave, anyone can get the vaccine. At least here, obviously throughout the world, that is a little more questionable. Regardless, the people most susceptible to the virus have received the vaccine. The elderly, the people who are likely to die, the people with pre-existing conditions, they have the vaccine. 99% of the recent COVID deaths seen in the United States have been unvaccinated people. So we're at the point where we have to learn to live with the virus. We have the flu. We had the flu vaccine. If you're vaccinated with the flu, it's very, very unlikely you're going to die. My guess is that's the situation that happens here. We've seen what's happened in the UK. They are hitting their highest cases now, but they are removing the lockdowns they had relatively recently put in place because they decided to hell with it. JP Morgan this morning reiterated overweight ratings on cruise lines despite their week-long 15 to 20% drawdown. This is bigger than the energy sector. JP Morgan is reiterating them at an overweight. Why? Because the sell-off, they believe, is being induced by Delta variant fears, yet we are not seeing Delta variant fears show up in the economic data. I believe the same is true with the oil industry. So that fundamental concern, while valid, while not at a 0% probability, will have, I believe, a very, very modest effect at best, and if at all, and even if it does, possibly increases in demand that are happening just seasonally because it's the summer, going into the hottest seasonal month, in addition to overall worldwide increases in activity, will trump it. So the final point, we mentioned this in yesterday's video, and if you're still looking for more energy analysis, fundamental energy analysis, go to yesterday's video, watch how we felt throughout the week. In this very, very painful week, the final point, we've said it before, we're going to say it again. OIH, Exxon, Chevron, take your pick of energy exposure. Its 52-week high was at $69 a barrel. We are right now above $71.50 a barrel. We're higher than that right now. It's been fluctuating. The market's been very volatile, understandably so. We can identify the reasons. Delta variant, OPEC uncertainty, both of which we believe are going to settle very shortly, wiping out the uncertainty. And we should expect new 52-week highs in the hottest, best performing sector of the market to date. So next week, the week after, we get earnings, but most importantly, energy earnings. We're going to see what happens. Exxon, Chevron, July 30th, that's a Friday. If first week of August doesn't turn our way, if something fundamental happens, we're ready to adapt. But right now, we're waiting for July 30th. That's the important date. So until next time, peace out.